Hi guys, welcome to another episode of the Blue Fort Blueprint. We've been away for quite some time, but here we are back again. Today we want to talk about something that's quite exciting. SEBI's brought three new regulations. The first one being some curbs on F&O trading, which was going absolutely crazy in India. Secondly, they've brought around a new asset class with a minimum ticket size of 10 lakhs. And the third is a new framework for MF Lite, right? And we're going to explain what all these three things are. It's going to have a big impact on investors, we're sure. So, guys, let's start off with the new asset class because I think that impacts us and our clients quite substantially, and very excited about that. I think all this time, the mass affluent people who had reached portfolio values of, let's say, 25 lakhs, 50 lakhs, 1 CR sort of mark, the natural progression after mutual funds was a PMS, right? But the problem was that PMS has a minimum ticket size of 50 lakhs. So there was a huge jump from mutual fund, which is a very small ticket size product. You can even do like a 500 bucks sort of investment to a PMS, which is 50 lakhs. And in the middle, there was absolutely no product for them to invest in, right? I mean, there's other products like ULIPs and insurance plan, but nothing worthy of creating substantial wealth. With this new 10 lakhs, I think we're very excited that SEBI has really relaxed the norms that or restrictions that they've put on mutual funds. This, I think, should be a big game changer. And I think a lot of investors should be interested in this new product.
No, absolutely. Yeah, it was a fantastic idea because there was a big gap between the top two products to invest in the equity markets. That is the mutual fund and the PMS.
Yeah.
Earlier, if you remember, around 5 6 years ago, mutual PMSs were still at around 25 lakhs minimum ticket size, which they then increased to 50 to avoid mis-selling and to avoid retail participation within them. And now what has happened is, especially after COVID, there's so much retail participation in the markets, right? You see the mutual funds also are I mean, there's what 23 24,000 crore inflow on a monthly basis.
Yeah.
So it was high time that people needed a new product so that our markets don't get over liquidity or something like that, to kind of just normalize them. And of course then it helps the PMS guys also to maintain that, distinguish that it's a high risk product than a mutual fund, right? So this coming in between really helps
And there was
investors.
a real gap in the market, right?
Yeah.
Because we see with our experience, a lot of people who have reached, a fair amount of wealth, they keep asking us, what should we do next? What, chalo, theek hai, mutual fund to ho gaya, but और क्या करना है? And people who've reached a net worth of, let's say, like 70 lakhs, 1 CR sort of mark, they're willing to take on substantial risk, especially people who are younger and who
Yeah.
have a longer
Yeah.
time horizon. But they still did not have enough money for a PMS. Putting 50 lakhs in one fund, which only has 15, 20 stocks, is too much of a risk.
Correct.
And then after that is AIF, which is a minimum ticket size of 1 crore, right? So with this new product, 10 lakhs is actually, in my opinion, the perfect ticket size that a lot of us, people in the early 30s who are doing well in a sort of corporate setting.
Right.
I think a lot of money will start now flowing into this. And let's talk a little bit about the reduced restrictions on this new product, which
Yeah.
otherwise mutual funds has, right? So
So one aspect is the fact that they've reduced the limit so that 10 lakhs plus people can invest. But more than that, I think this is a truly differentiated product because what SEBI is saying or what they're looking for is strategies which have not existed before in the mutual fund or space or even in the PMS space. So long short kind of strategies which were restricted to AIFs till now, which were 1 CR plus, can now be done in this. So the exact guidelines are not out yet. What kind of products will be there? But this, I think, will be quite different to just traditional mutual funds or PMSs in their offerings as well.
What I like actually is how SEBI is thinking, right? They're thinking like how corporates or a business would do, wherein identifying where the gaps are in the market. Let's say any
yeah,
business would do that, right? Identifying their clientele, understand where the gaps are, what to kind of fulfill. And
yeah,
with this product coming in, I think they've navigated that very well because it will balance out the liquidity in the top three products properly. This being the second one,
yeah.
correct? So there'll be less liquidity in mutual funds and of course PMSs. As well
Yeah.
because
And
this certainly comes somewhere in between
the good
nicely.
thing is that the people who will launch these strategies, so they're called these 10 lakh ticket size products will be called strategies and not
Strategies,
funds.
yeah,
And that's how it'll be differentiated in terms of name, at least. It'll be launched by the AMCs itself.
correct.
So very experienced promoters who have been in the financial services or asset management business for a very long time, they're going to be handling it, right? So it's not like a new entities will come into this. Very experienced fund managers will be there. So I think we should all be very, very excited for this new product. That's number one.
I'm
Number two,
actually, just
yeah,
to add, I'm quite excited about the products that we can see in this, in these new strategies. Globally, there are different products like inverse ETFs. So if the price of an index goes up, then the value of this product comes down. So an inverse ETF like that, high frequency trading, long short strategies, all of these things which have not really existed in the Indian markets and have existed very popularly globally, those things can now come in here.
Correct. Yeah, inverse ETFs was actually a very big one
Yeah.
with this new product. So
That
that's
it makes it easy for you to short or even leverage ETFs. So,
correct.
for example, if an index is going up 1x, but these leverage ETFs mean a gain of 2x or 3x. So, these kind of strategies, I think India is now developed enough to have these kind of options available.
So that's number one. I think number two is the MF Lite framework. So what SEBI now wants to do is that any asset managers who want to launch only passive indexes or passive funds rather, right, that are based on a particular benchmark or index, it's going to the regulation or the is going to be a lot more light touch. So opening up an asset management business or a mutual fund house is not very easy. You need a minimum net worth criteria. There's a lot of compliance that's involved. But now with this new light touch framework, a lot of new AMCs will come in, right? Right now we have around, I think, what is it, 43, 44 fund houses. A lot, yeah, a lot of new AMCs should now come in who will launch only passive products. So the advantage of launching a lot more passive products is that it makes it a lot, first of all, a lot more low cost to be investing in the market. Secondly, the liquidity improves drastically. So right now, a lot of our passive offerings are only, let's say, based on Nifty or Sensex or maybe the bank Nifty. But now you will see all sorts of fancy or like smart passive products being created whereby you can invest in particular sectors. You can invest in, let's say, Nifty 250, Nifty 150, and all of these sort of offerings will increase, which again promotes liquidity and only promotes participation in the equity markets, right?
Yeah, I think it's a good thing. SEBI in general has been quite proactive in approving MF licenses as well. So if we see in the last few years, a lot of new AMCs have
AMCs.
come into the industry. What they're trying to do, I think, is be less heavy-handed on the regulation and let market forces take care of things. So they're trying to promote more competition within the industry and more product availability to investors, which is in general a good thing.
Yeah.
No, these are forward-looking ideas. Yeah, you say USA or let's say the Western markets, right? They have been passive, I think, in the last 15 or 20 odd years. And India, there was always this argument, and I believe there still is there's an argument where active management will outperform, the benchmark and the passive ones. But still, by having more options and just giving the client or an investor the idea that, okay, you know what, you want a low cost fund, you want to participate in the market, just go for this, and there are so many options available for you, which improves the market overall.
Yeah, and it makes sense also. Why have the same framework or regulation for active and passive? With an active fund manager, there's obviously humans involved
Correct.
with active decision making. So the scope to go wrong is a lot more. Therefore, with active funds, you need to protect investors to a greater degree.
Correct.
But with passive, even like a team of 3 guys can actually manage like 15
Yeah,
funds. It's
absolutely.
based on a benchmark and it's really the computers who are doing the investing, right? It can be so seamless. So again, very exciting because we're going to see a lot more AMCs and like a lot more asset management companies getting into the foraying into this field, and so many more options open for you guys, right? So that's absolutely fantastic. And third, I think another reason why I feel markets might also be correcting this week is the curbs on the FNO market that they've announced, right? So they've
Yeah.
announced 5 sort of restrictions which used to earlier not be there. In the earlier episodes, we've discussed how India has become an absolutely speculative market where a lot of people from the rural or urban setting also, a lot of unemployed guys, all they're doing is option trading, right? They're making $1,000 per week. And just because, and that is not something that can be promoted or continued. So they've announced some restrictions also on FNO curbs, right?
Yeah. So before getting to the restrictions themselves, I think the broader story is quite important. You see a push from the finance ministry, from SEBI, to try and curb this because everyone sees this as an issue. So if we see in the budget a few months ago, they raised the STT for FNO. Recently, SEBI came out with that survey which showed that 93% people make losses in FNO, right? Which again goes towards that trying to put that knowledge out there that it's not very profitable. And now, number 3, these restrictions. So clearly, SEBI is trying to rein that in. And that study that I just spoke about is very important. It says that 93% people make losses. All of the profits of the industry in FNO trading is going towards high frequency traders and family offices.
Right.
So guys who are very well funded, who are using tech in a very good way, those guys are taking the profits and individuals are making the losses. So it's a simple case of man versus machine, and the data shows that machine is winning out.
Even in the 7% that is, let's say, profitable, right? And from FY22 to FY24, which is the base for the study, Only 1% of the people, that would be the machines, as Sayyam said, have made profits over 1 lakh. So even
Yeah.
let's say in 2 years, you've traded, you've taken so much stress, risk, whatever you say, right? And you have a profit of 99,000 and lesser. I mean, it's not worth it, right? You're going against the data for what?
So what are the restrictions that have been announced? Somebody want to take our viewers through that?
So one of the main ones that I think is going to be a huge factor is that they've increased the minimum lot size.
Yeah.
So what right now the future an option contract that you can buy is going to go up by 2.5x. So whatever you could buy today for say 5,000, that's going to go up to 12,500, right? And that creates a huge entry barrier for someone who's buying and selling every day because that's how much more capital they need.
The other four, Viraj?
Even margins are significant.
Viraj has no idea.
Absolutely no idea.
No. So I think another one that they've
Margins.
Upfront.
Margins
You have to-
what?
Upfront premiums.
Upfront premiums.
You have to pay the premiums upfront.
Hey, cut it and do it.
Where's your
No,
chits?
I'm
bhai?
not cutting this.
Where are your chits?
In the car, maybe.
We're keeping this.
Keep it.
No, so I think another one that they did was so far every week there were several indexes
Yeah.
of which derivatives you could purchase, right? Nifty Bank, Nifty. And all of these were expiring, at least on the NSE.
On a
if I'm not
weekly
wrong, On a
basis.
weekly basis.
Yeah.
So every Thursday, India used to basically turn into a casino, right?
Yeah.
Once a week, India used to turn into a casino where millions of people are just betting on that one day, and everybody's doing intraday trading. Nobody's holding on to these options, right? And now they've said that only one of the benchmarks can be used, right, to have a settlement on a weekly expiry. Everything else will be monthly. So again, the volume significantly comes down,
Yeah.
right? I know some people in my building. We all know some people who are literally trading every week in multiple different indexes.
Day in, day out.
Literally
forget week.
everywhere. I mean,
Yeah. Yeah, so that is another very good measure taken by the SEBI. These two measures alone, increasing the upfront premium, reducing the number of indexes that derivatives can be traded on a weekly basis, and the first one
increasing
that they
the
said,
contract
increasing
size.
the contract size, right?
Significantly, that-
Let's go,
significantly.
SEBI.
Yeah, that should seriously deter at least a lot of the people who are doing in a rural, unemployed people who are doing in a rural setting who can't afford to lose money. Those guys at
Which
least
is
will stop.
93%
But
of
one
the
thing also,
population. by
if you
the way.
guys realize, right, even when we are growing up, or let's say since we have been in the business, the last 2 years, I would say, 3 years, I would say, this is the maximum SEBI's come out and openly published their
Yeah.
researches saying that, okay,
Yeah.
you know what, FNO is bad. They're outright coming to you and telling you that please don't do this. For some reason, of course, we all come across people who just want to make that quick buck, right? And do not learn from those researches. But I'm sure if SEBI tries more and these restrictions and so many other things, correct, will help them kind of
Correct.
not make it a casino.
So if you see, Nitin Kamath actually said that he expects trading volumes to come down by 60%,
Yeah.
which
Correct.
is, I mean, if he's saying it's probably in the right direction. So that's huge. But also, if you see all the 3 points that we just discussed in conjunction, what SEBI wants is that people don't trade in FNO themselves. Clearly, they're making losses. They're trying to promote more institutionalized investments.
Correct.
So passive mutual funds, they're making it easier for that. They had introduced a new asset class which is also professionally managed. So people, even if they want high risk strategies, they can go towards those kind of products rather than doing it themselves. Clearly, that's not working, and SEBI, I think, is doing a very good job.
Yeah, on a side note, I'm wondering what's happening to all the broking share prices and also NSE's share price. Obviously, NSE is not listed, but in the last 1.5 months, it had sort of 2-3 months ago, it had skyrocketed to
NSE.
6,000 odd levels.
Still that.
Are you sure?
Yeah.
No, but in the last couple of
No,
days,
in the
I'm
last
sure it'll
couple
get
of days.
reflected.
300
Huh?
right now.
If FNO
As we
volumes,
speak, you checked today.
Yeah.
I do think, because these businesses are very cyclical. When the things are going well, everyone's participating. And when the market falls 5-10%, a lot of retail investors will be like, you know what, this is not for me, I'm losing money. And will exit. This is typical of every cycle.
Broking
to
stock
be
prices
honest.
have corrected, right?
Broking
Angel
sta-
broking and all that, they have.
Yeah, they
Yeah.
have. And broking stocks are very cyclical. If you see these companies, they don't get great valuations because everyone knows that it's very cyclical.
Yeah, I mean, if the founder of Zerodha is saying our revenue will drop substantially,
60%.
then obviously, these stocks will correct.
Yeah.
Right. So that's on the 3 new updates that SEBI has given us this week. One more thing, guys, we wanted to talk about is equity participation via stocks versus mutual funds, right? Again, we've spoken about this before, but what I'm seeing right now and what some clients are telling me is that my direct equity portfolio is down by 5%, 10%, but Nifty is an all-time high. So what's happening? So it seems that there's a sector rotation that is happening. A lot of sectors that were extremely highly valued, a lot of stocks, especially in the small caps, PSUs, right, railways, defense, stuff like that, were highly overvalued. So they've begun correcting just a bit. Also, the style of investing is starting to change, right? Stuff like FMCG, IT is doing better, banking, chemicals, stuff that has not been doing. So it seems like there's like a regime change happening in the market, and if you're caught on the wrong side of it, right, via direct stock investing, then I think you will, you will find yourself in a position where market is not quite corrected, but somehow your portfolio is down by 15%, 20%, and this happens all the time.
Yeah, I think simply put, the downside risk in a direct equity portfolio is significantly larger than in a mutual fund portfolio, and that's something that we have seen consistently, because people go big on certain stocks, and those individual stocks can correct 50, 60, 70%, whereas through a mutual fund, the fact that you have a diversified portfolio which is studied in detail and analyzed in detail and exited, any stock within that is exited if and when needed, that just protects your downside significantly more.
Look, it might seem extremely biased, but I'm tired of saying it. Mutual funds are way, way, way better than stocks. And this is not because of what is happening, maybe a sector rotation or whatever. Sector rotation keeps happening every one year, 2 year, 3 years. Cycles come and go. There's a growth cycle, there's a value cycle. We keep saying that, right? People don't understand that most of the people, especially those who are investing on tapes or let's say looking at past returns and all, jump onto the rally after the rally's been done.
Yes.
Right? If let's say you tell me PSU पे अभी आगे जाना, PSU में 90% return आया है, 100% आ गया return एक साल में. Now if you jump on it, you're definitely going to make a loss in the next 2 years, right?
Correct.
Also, what Sayyam said, with a direct equity portfolio, if you are way too diversified, you're operating it like a mutual fund. You're not going to be defeating the fund manager who has much more information than what you have.
Yeah.
If you operate it in a very concentrated manner, you have to be extremely lucky to have that particular stock at the right price, which is going to give you 1000x, 2000x, or whatever they're expecting, right? So, I mean, it is, of course, it's very easy to just open a demat right now, as you mentioned, Zerodha, Grow, whatever. Just go there, put some documents, and okay, chalo ye share le liya, wo kar liya. But it's the harsh reality that people want to burn their hands and then come to mutual funds. So be it.
Yeah.
See, the thing is, any conversation that I'm having right now with any new prospect, for example, a lot of them are saying that in the last 1 year, my direct equity portfolio has done so well that I don't really need anything else. I'm obviously killing it. But then the question that I ask is, forget what's happened in the last 1 year. It's been an anomaly. Ask yourself, who is a better fund manager? You, who has a full-time job somewhere else and you're investing based on tips, or the guy sitting at Kotak, HDFC, Axis, whichever mutual fund who's managing lakhs of crores of rupees, has access to so much information, is doing this full-time. Who is going to do a better job in the long run, right? Just if you think about it objectively, it's obvious that the latter will do a much better job.
No, we've discussed this before, right? When in a bull market, or let's say a market which we are seeing from 2020, 2021 onwards, everyone becomes a fund manager. All they think is, जो मैंने लिया वो बढ़िया है, ये मेरे को इतना रिटर्न दे रहा है, मुझे कुछ भी नहीं चाहिए, ना FD चाहिए, ना म्यूचुअल फंड चाहिए, forget about everything. Now the same person from Monday to Friday, they would have called us 3 to 4 times, क्या लग रहा है, क्या लग रहा है, क्या लग रहा है, right? If you're a fund manager, just be one.
Correct. we had gone to a Kotak conference recently,
Yeah.
and they had mentioned in Nilesha, who's the MD of Kotak, he had very beautifully explained one type of stock. We've spoken about free float and small caps and all of that,
Yeah.
which you have to be very particularly careful about.
Yeah.
So I think that is worth mentioning to our viewers, that if you're holding to anything of that sort that qualifies in that category,
Yeah.
that definitely is a sell. So what did he say again?
He linked it with the movie Amar Akbar Anthony.
Yeah.
So he said Amar stocks are the good quality stocks which you can
HDFC.
keep and hold, and exactly those the likes, which that even if they've not performed as well in the last 1 year, they'll still be fine. When the downside comes, they'll protect your capital. But Anthony stocks are the ones which look really exciting right now, which have done well, possibly because the liquidity is so less that even a bit of buying drives up the share price, and then that ends up being a self-fulfilling cycle. It just keeps going up. But what you have to understand is, on the downside as well, that becomes self-fulfilling, where people start selling and there are no buyers, and the stock falls 60, 70% immediately, and you can't get out of it. And that's that's something we have seen in previous cycles multiple times. And that is exactly what we have to look out for. Just because a portfolio has done well does not mean it's a good quality portfolio. In fact, in the last 1.5 years, I've been telling people that the worse your portfolio is in terms of quality, the better your performance would have been, but that will turn around.
Yeah, and one more thing about investing in stocks versus investing in mutual funds is that with a mutual fund, you know exactly what your IRR is, so what your true annualized return is, right? Almost all softwares show you that. Funnily, when you ask somebody who's doing stocks, right, because they're also buying stocks, they're also selling stocks, on maybe a daily basis, maybe on a monthly basis, whatever it is, nobody knows what their true IRR is, right? There's no brokerage that ever showed you. Like Zerodha mein, show me that one place where the guy shows you this is the IRR you've generated since inception on your stock portfolio.
Yeah.
There's
Not only on the holdings, but what you've sold and everything as well.
yeah,
Correct.
on all the
Correct.
transactions, your true IRR, your true that one annualized return that you made on your stock. Show me that one place.
Correct.
Is it hard for
Not
Zerodha
possible.
to? Is it hard for Zerodha to put that? No, it's not.
No,
It's a simple
The
formula.
revenues will drop by 80% if they do.
It's a very simple formula, right? To show somebody what the stock IRR is. But I show that on my software. When people invest with me through mutual funds or any mutual funds, every advisor or every sort of broking house within mutual funds also, they show you that this is exactly the IRR that you're getting. Right? But with direct equity, it's not there. And this is not by chance. This is by design, guys. If you guys actually find out, not you guys, but in general, direct equity people, investors actually find out what the IRR is, you'll find that maybe not in the last 3 years, but let's say over a longer term horizon, people are not beating Nifty. Nifty ko to choda, people are not even maybe getting FD returns. And this was actually a study done that most direct equity, when the markets turn bad, they're not even beating FD returns. Right. So understand that what an IRR is, first of all, and understand how to calculate on your stocks. You might, be in for a rude shock.
The problem is recency bias is huge, and survivorship bias, right? So when people look at their portfolios, they always remember and talk about that one stock which became 5x or 6x, right? That's what they'll go and tell all their friends. But what about all of the others which are not beating FD? A lot of them are down 50-60%. On your overall portfolio level, no one discusses that or even looks at that. And then they keep trying to find that next multi-bagger. The problem is that how hard is that to find? It's much easier to just let regular compounding happen through the funds, and in the long term, that always wins out.
Wish it was that easy. It's been 10 years in the industry. We're tired of saying it.
Correct. Yeah. I think one last point I want to bring across is that everyone has to seriously sort of realign their expectations to what the returns will be
Yeah.
going forward from
Yeah,
here. It's
absolutely.
a very, very important point, guys. The days of getting 25%, 30% by putting in whatever crap, those days are maybe over. There was some fundamental reasons why it happened, right? COVID ke baad, the results of the companies have actually done that well. All the liquidity that was pumped into the markets by the US, India had worked from an economic standpoint. India has done extremely well. But of course, that's not going to continue forever. We're not going to get a 25% CAGR forever. Going forward, even if you remember the long-term equity returns in Nifty is about 13%. The long-term returns in mutual funds are about 17 to 18%. So if you are still in that mind frame where I want something that I'll get 30, 35%, 40%, most likely you're actually going to be sitting on a loss after 1.5 or 2 years. So if you understand that, that's great. If you don't, then I think learn it the hard way,
Hard luck.
and you'll just you're just gonna have to go back to 2018 to see what happened over there, right? You might see that your portfolio is actually corrected by 70-80%, especially the stocks you are holding, even though Nifty is not really fallen by more than 5-10%. So be careful, and understand what expectations to set from here. So thanks a lot, guys, for listening to this episode. Let us know in comments, write some new questions, please. So we'd like to answer those in the next episode. See you soon.